Hey there, it's been a while. This video and subsequent ones in this series on mean reverting trading are going to be a bit different. Someone asked me to go through a book and kind of describe the mathematics involved, and this book has to do with just what I said earlier, mean reversion in trading. And in particular pairs trades. So this is just a preliminary video describing like what the hell is a pairs trade. So we will do that and then describing the mathematics in the book and showing how just to calculate the quantities that they're indeed trying to calculate. I'll probably add on to it a bit because they derive analytical formulas for every quantity that I've seen so far at least. So I'll try to generalize this a bit, assuming that we cannot algebraically derive these quantities, and how would we use a computer to calculate them if we can't do it by paper and pencil. So pairs trade. Let's just switch over to a notebook and I'll talk through it. Okay, so I'm just going to use the notebook to plot things out here and just kind of talk my way through this. Let's make it a little bigger, maybe a little bigger still. I changed my monitor recently, so let me know because the resolution has changed if this is too small on the screen. So the general idea behind most pairs trades that I've seen is that one chooses two underlines that are very strongly or relatively strongly correlated, or perhaps inversely correlated. In the case of positively correlated, let's choose SPY and QQQ. So the S&P 500 and the NASDAQ 100, S&P 500 and NASDAQ 100 index ETFs. This code just pulls in data I downloaded from Yahoo a few weeks ago. And let's plot these side by side. So you see they're pretty damn close in terms of like gross features. They're both going up continuously over this time period from here to here, here to here. But again, just by eyeball, you kind of see here that the NASDAQ, the Qs here, have a little bit exaggerated moves compared to like this spike here. In the spiders, you have a little bit of a bigger spike here in the Qs. And then kind of midway through this plot here, it drops a lot more and you really don't see a corresponding dip, or at least there's a very small corresponding dip in the spiders. So the general idea, oh, and here are the correlations in terms of both price action. So in terms of price action, it's very highly correlated, 97+%. In terms of returns, again, still very strongly correlated, more than 86%. So as a bit of nomenclature, and this is kind of arbitrary. I just happen to write this as SPY QQQ. So I'm going to define the pair, or being long the pair, as long spiders, and since they're positively correlated, short the Qs. So we're going to have some number of shares alpha of SPY, and we're going to be short some number of shares beta of the Qs. And just for this video, I'm going to choose alpha and beta. I'm going to choose them based on notional value. So if alpha were 100, if I were long 100 shares of spiders, that's what, roughly speaking, is about $32,000. So I would choose beta to be $32,000 worth of QQQ. And I just kind of calculate that here. And then I plot out this pair. Where is it here? So this is basically one share of SPY minus that ratio QQQ. And of course, using my definitions here, if we were short the pair, we would be short, this would be minus alpha SPY plus beta Q. So we would be long the Qs, short the spiders. So if we were along the spread, this is basically how it would have played out over this range of times. So obviously we start at 0 since we're long and short an equal value of notional here. And then this spike, you notice that the pair kind of sells off here at this spike corresponding to this dip right here. You notice that the Qs shoot up a higher percentage than the spiders do. So since we're long the pair, we kind of get killed. We would get killed on that. But if we had bought the pair here, we kind of would have made money. And kind of correspondingly here, we kind of have this high point of the pair. And if you notice here, the NASDAQ kind of shoots up way more than the spiders. So again, using my definition, if we were short this pair, so we were short spiders, long Qs, we should have made money. And again, here, as you see, again, this plot is long. This gets confusing because of all the longs and shorts. But, if we were short the pair, we would have made money because this pair was dropping in value. And again, gold and GDX, I'm going to define it the same way. Again, these are very strongly correlated, just eyeballing it. It's not quite, doesn't seem to be quite as good as the spiders and Qs, but still pretty good. So the correlation coefficients, again, are pretty high. In terms of price action, it's only 90% instead of high 97. But in terms of returns, it's still 83, so it's still pretty strongly correlated. So again, same idea here. If we had bought gold and sold GDX against it at time equal to 0 here, we would have made money. And again, if you kind of sold the pair, so short gold, long GDX here, you would have made some money as it kind of drops down. Instead of indices and commodities, you can kind of also look at kind of companies in the same industry. So we have Coke and Pepsi. This is kind of the one you kind of see classically if you look up pairs trading online. Again, fairly high degree of correlation, but not as drastic as those other two. So what do we get as far as correlation coefficients here? So only 86% in terms of price action, 62%, 61.5 in terms of returns. And again, you kind of get this if you had bought the pair, say at this point, kind of midway in my timeline here, it would have shot up and made money. So that would be long Coke in this case and short Pepsi. And counter to that, if you had shorted Coke and bought Pepsi here, you would have made money as it dipped down, assuming you closed it down here for a profit. I tried to find some things that were inversely correlated. I didn't want to do VIX and S&P because VIX is always weird. So I tried S&P and bonds TLT. So these are kind of inversely correlated, but although you kind of have, for this last portion, you have this positively correlated part. But for this time range, S&P has basically just gone straight up, and bonds have gone down and then kind of bounced back a little bit here. Here's the price of the pair. Now, since these are inversely correlated, remember we were long, like in this case, where was Coke and Pepsi? Coke and Pepsi, where are you? We were long Coke, short Pepsi. Since these are inversely correlated, we would want to be either long, we would either be long both or short both. So it'd be long, long, short, short, as opposed to long, short, short, long. I know it's confusing. So the price action is actually fairly strongly correlated, but negatively correlated, negative 87%. But returns, not so much. I would have suspected a little stronger than this, but apparently not. I'll double check this later to make sure I got all the code right. But yeah, so let's go to a plot here, a pair that has a little bit more interesting value, interesting behavior. So we'll do Coke and Pepsi right here. So there's an assumption kind of built into this that may or may not really apply to stocks by themselves. And that's the idea of mean reversion of price. Now, stocks, generally speaking, do not have mean reverting tendencies in terms of their price. So I tend to be contrarian. So if a stock like Apple were down, I might buy it and then sell it if it went up. And again, short it if it were high, kind of at record highs, and assume that it would go down. But that's just a random assumption, and I really realize that the probability of that happening is basically, it's 50-50 bet either way. Now we're only looking at a year of data here, but this almost seems like it oscillates about this value of 2. So what we're going to do in subsequent videos is assume that these pairs follow some sort of mean reverting statistical process, one called the Ornstein-Uhlenbeck process, which is kind of shown here. And you'll see this written different ways with the mu and theta interchange, but the book that I'm looking at does it this way, so I'll keep that nomenclature. So I've just generated some random data here that kind of follows this statistical process with theta set equal to 1, mu set equal to 0.2, and sigma to 0.15. And I just generated a bunch of points, and you see it oscillates about it kind of oscillates about the value I set for theta. In fact, if you stare at this equation here and just ignore, set sigma equal to 0, so kind of get rid of this random term here. This is just a differential equation that can be solved by hand, and it happens to be the solution happens to be a decaying exponential. So if I come down here and get rid of my sigma, set it equal to 0, this should decay down to the value of my theta, which is set equal to 1. So let me rerun this code, and we get exactly that. So in general, we're going to assume that our pair follows this type of statistical behavior, and as such, as it gets far away from whatever that mean is, that value of theta, we're going to assume that it's going to be pulled back towards the mean. And in the next video, we're going to basically go through and show how to calculate mu, theta, and sigma for this type of statistical process. And again, this equation is assumed. We have no way to know if it does hold. Some of these processes do tend to look like that, but again, we're just assuming that it's going to hold true, and then we're going to try to pull these parameters out from the data and this equation. Awesome. So in the next video, we will go into that parameter determination, parameter extraction code. Also, the book in question discusses determining the optimal alpha and beta, so the number of shares of each of the pairs. So we'll do that as well. And again, I want to reiterate that this assumption of mean reversion is just that, an assumption. You have to do additional tests to determine if there is some reason to assume that. You can fit anything to anything. So I could, I could fit a parabolic curve to some sort of price data, and of course that's not going to reflect reality. And the same could potentially be true for this as well. So that's something to keep in mind. Okay, but having said all that, yeah, until next time, I'll see you later.